everybody. It is Monday, August 25th. This is the Daily Rip Live. I'm Katy Perry. Today, we've got two esteemed guests. First up, Steve Hou, quant researcher at Bloomberg. Steve, how
Hi.
are you doing?
Hi, Katie. Thanks for having me back. Very
Well,
well.
thanks for giving me a tour of Bloomberg the other week. That was really rad. And I
Yeah.
went on eBay and bought a keyboard.
Yeah.
But you guys
That's great.
you can buy the Bloomberg keyboards on eBay. Mine was about $100. Well worth it. It's very you don't make keyboards like that anymore. They're very square, the keys.
Indeed. Yeah, it's one of those, I guess classic mechanical keyboards.
Yeah, it's great. It takes up like half my desk. It's a real big honking
Yeah.
keyboard. But
Yeah, you can see those functional buttons at the top that points you to individual market instruments. Yeah, it's great.
yeah, doesn't do anything on my computer because I don't have the terminal. I was hoping if I
Well,
hit
one day.
something
Yeah.
one day, if anyone wants to gift me one, the holidays are coming up. I also want to shout out our producers. Our new entry song has me feeling very 90s. I feel like I'm the main character of some sort of movie where I'm going to fall in love with Freddie Prinze Jr. or something. So we hope you guys enjoyed that too. Steve, it's interesting. This is the week before Labor Day. I'm walking around New York, I'm like, where the hell did everyone go? But there's kind of a lot going on this week, considering, this is one of those weeks where after, Wednesday, Thursday, people start to drop off.
Oh, absolutely. Yeah, I think we're just sort of on the cusp of people coming back, right, from the summer vacations, hedge fund industry coming back from, the Hamptons.
Yep.
So, it's a bit of a lull here as well, but we do have interesting stuff happening in the markets and especially, macro economy. We just got I think, bit of a signal from the Fed last week, right, the Jackson Hole. So,
Yes, we did. All the rich people were in Jackson Hole, and there's a Friday rally as a result to that. So,
yeah.
for anyone who maybe was at the Hamptons this weekend, we hit a record high after Jerome Powell pretty much confirmed the Fed is ready to cut rates, but nothing's for sure. I think our guest Ryan's going to talk about that. But he signaled a policy shift, acknowledging inflation is still running above target. But he did warn the bigger risk now may be the labor market. And he said downside risks to jobs are rising, citing July's weak employment report. Steve, what was your reaction to this speech? It is likely his last one
Mhm.
at Jackson Hole.
Yeah, indeed. This is likely the last meeting Jerome Powell, as a Fed chair, will host at the Jackson Hole, give at Jackson Hole, and yeah, he's definitely, keen on sealing his legacy. I have a slightly different take than I think a lot of people seem to have had, or certain market had, based on what he said on Friday. I think he did give a bit of a dovish pivot in that he acknowledged the argument made by some people on the Fed, such as Fed Governor Chris Waller and Bauman, that basically you have this sort of downside risk to growth, and labor, job market growth has actually slowed and recently been revised downward. And you also obviously see anecdotally young graduates having a hard time finding jobs. Hiring rate is very low. You have this no hire, no fire economy, despite the fact that overall headline, unemployment rate is pretty low. That being said, I mean, I don't think he said anything substantively different from what he had said in July, that they see the risk as being balanced on both sides. The fact that he acknowledged the growth, sort of Waller argument more, was probably read as dovish by people, more or less guaranteeing a September cut of 25 bips, barring any sort of major news shock, which we can still get, right? We can get more data on the labor market and inflation print before the September meeting. But that being said, I mean, beyond September, it's still very much data dependent, and depending on what we see in terms of market reaction, long-term interest rate, how you react to what Powell said, as well as what happens after the rate cut, in terms of inflation growth, we may not get more cuts. So I'm not sure there's really that much more that we learned. But
Yeah.
market, I think, liked it, I guess.
Yeah, do you think it's an interesting take? I never thought of this, but do you think it's a case of people hearing what they wanted to hear and reacting accordingly?
I think there's maybe part of it. A part of it is also perhaps positioning that. So going into Jackson Hole, there was a lot of, I think, caution, because market had already run up so much. We were just looking at anything that could potentially tip us into some kind of a sell off, right? and there was already market had already gone down, like I think 5 sessions in a row before Jackson Hole. So the fact that he didn't come out, more hawkish than expected. He could have come out and gunswing and say like we're not cutting, like this is the worst, and then we're just going to be sort of super hawkish. But the fact he didn't do that probably turned out to be better than people expected, and that's probably what reflect the market reaction. But I do want to say one thing is that when it comes to Fed meetings, FOMC meetings, since I think especially after COVID, we have observed with a great, I think, degree of regularity that first move is often wrong. That market can sort of rip on something that Powell says during the FOMC presser, right? He will come across as this sort of nice dovish uncle, right? Who would never want to say anything upsetting. And then the next day, people are like, wait a second, he didn't actually say anything that
Yeah.
was actually good. And then market dumps. Or the reverse, where he will say something that was perceived to be hawkish, and then later on, it's like, actually he didn't say much at all. So he bounces the next day. So I wouldn't be surprised if we see a bit of a, sort of reversal today, but from last Friday,
Yeah, there
which
must
we
be
are already seeing. Yeah.
Yeah, I mean, there must be a lot of like strategy around, like to your point, managing the positioning, you carefully
Yeah.
choosing words, being vague but specific enough. I mean, the Dow was up 850 points, about to close at a record high. S&P, Nasdaq also jumped, but to your point, they're dipping a little bit today. So I wonder if it is, a little bit of a weekend hangover where people might be kind of looking back at the commentary like you did and said, "Wait a minute, like, did he really say this?" My question though is this, and this might be like a daft question, but like you study this stuff and for Powell, when you talk about legacy,
Mhm.
if there's a lot of very loud voices wanting him to make these cuts, including the literal president. Why wouldn't he just cut and, like, whatever implications there are, he can just throw up his hands and be like, "That's what you guys told me to do." Like, what you know what I mean? Like, he at this point, he's like, what is his impetus for not cutting, I guess?
Um, I think it is legacy, right? And I hear what you're saying, and in fact, I think I've made some argument, not quite exactly that, but something along similar to that line, that they could do some kind of a policy trial balloon where they cut 25 bips and see what happens. And if inflation goes in the wrong direction, if 10-year yield, sort of goes up, similar to what we saw last September when they cut, and then, in response to what was actually a growth scare, and it wasn't, and 10-year yield went up, inflation went up, and the growth actually was resilient. um, if we do see that, then they can point to that and say, hey, that's the reason why we cannot keep cutting. And in fact, we may actually have to hold here or even potentially a hike at some point. That is more hard data in hand rather than sort of being anticipatory and say
Yeah.
we were worried about what might happen. I think the reason they are careful is because historically, the Fed has been very averse about making turnarounds, and the whole communication is difficult. So once they start cutting, there's expectation of they keep cutting. That sort of norm has been what drives them. But we are clearly not in the world of norms anymore, right? The president certainly doesn't seem to be,
Yeah.
certainly seems to be breaking some norms day to day. So I can certainly see why. I think that maybe actually partially why we're seeing some cuts, right? So
Yeah.
September.
Yeah, I mean, it is, I'm thinking like from a typical person's standpoint, it's like if someone's pushing you to do something, the best way to show them you think they're right is to do it and have it go your way and then just be like, but this is impacting a lot of people in
Yeah,
in a
exactly.
lot of economies. Um, let's talk about the policy, and we talked about kind of impact on stocks, but ripple of impact into crypto and bonds. So we
Mhm.
have Treasury yields dropping, the dollar weakening. We saw, um, some crypto pulling back over the weekend, including Ethereum, after hitting an all time high. How should people think about how a Fed decision would impact those corners of the market?
So a few things, right? Actually, the fact that 10-year yield initially dipped, right, on Friday when when Powell came out dovish was probably a comforting, reassuring sign that this was not immediately, out of the gate a policy error of premature easing. When inflation is still a risk. because you would expect it that if that were the case, the 10-year yield would have gone up. So we will see what happens. I think that's why it's important to watch what happens in the 10-year yield in the coming weeks. It's possible that what happened on Friday was just a purely mechanical positioning thing where sort of people had to sort of unwind some of the hedges and so on and so forth. So that's on bonds, and then stocks. Are probably unsurprisingly, if you saw that as a dovish pivot, then stocks probably rallied from what had been the sell-off prior. I think crypto is interesting. Obviously, part of it is just simple risk beta assets going up, but I think part of it also is we seem to be living out this self-fulfilling prophecy on crypto, which was always sort of positioning itself as a hedge against whatever is happening in the fiat currency space with sort of sovereigns running perpetual deficits, and sort of they're creating a demand for an alternative asset. But that being said, I mean, we are seeing right now, as you're seeing, on the screen, that we're seeing a reversal from last Friday, right? So the first move was always wrong. Seems to be playing out at least a little bit in crypto land.
Yep. Well, we're gonna go back to talking about the Fed and Jackson Hole when we bring Ryan in, because I know he has thoughts too, and want to give him a chance to
Of
dig in
course.
there. But let's talk about the word that no investor wants to hear, which is stagflation. So it's
Mhm.
of course slowed growth. Sticky inflation can really run amok on the markets. I know, Steve, you've been doing some digging and number crunching on a systematic strategy for a potential stagflationary environment. Talk us through sort of what you're seeing, what you're thinking in that sort of scenario should it play out.
Yeah, so stagflation is a scary word, and people have been throwing around. This was referring to the phenomenon in the 70s, right? Sort of the traditional macro intuition about, inflation is such that, there's a trade-off between inflation and growth, right? So if you let the economy run hot, right, inflation will go up, and unemployment will go down, and you have a sort of a stronger economy, and vice versa, right? But you can have a scenario where you can have adverse reactions in both. That's in a world in which basically inflation is high, and persistent, while growth is weak, right? And we certainly and in the 70s we saw a very dramatic version of that where unemployment went up while inflation sort of stayed high. This was violating what is very famously called in macroeconomics the Phillips curve, right? Negative correlation or relationship between unemployment and inflation. So I think we're not in that world, but we're getting a taste of it, right? You're seeing basically weakness in the economy as inflation sort of continues to, remain high above the 2% target, and in fact drifting away from it recently. So that's, I think, what I would call a stagflationary environment, not necessarily outright stagflation. So the question is, how do we embrace this environment? I've actually been always making the point that we are living in a world with, I think, a much more, I think, generally inflationary environment, right? I think there are structural reasons beyond what the Fed is able to do, and this is one point that Powell made, at the Jackson Hole last week, that he said monetary policy is able to deal with cyclical, factors, but it's not able to overcome structural factors, right? One man cannot stop the mega wave. So what are some structural factors, right? So a couple of years ago, I gave a presentation on the, sort of a inflationary regime, and I say there are basically four main factors that actually means that we're going to be in a permanently, perhaps for a decade or more, in a more inflationary environment. So things such as deglobalization, right? And the geopolitical tension between US and China, and essentially a reversal of what we saw in the prior 40 years. That's one point. Another point basically is demographics, right? We have a aging demographics, and older people are not going to be as productive at working, but they have accumulated assets and need to be taken care of, right? And we're not at a point where we have enough robotics to take care of
Yeah.
old people. So, and then you have essentially debt, right? Debt, basically, all the sovereign governments have run up an enormous amount of debt that they now need to somehow finance in a world with lower, productivity and fewer workers, and not to mention all the implicit promises made on people's healthcare, right, on retirement, that is not even as explicitly sort of, sort of seen in the outstanding marketable debt. So I think between those, and by the way, at the time I said this, and let's see if it plays out, is what I called the 4Ds, the last D being decarbonization, that there was this drive towards sort of ESG, which today is, I think, politically not as popular, but at least parts of the world, like even Europe today, you have this anti sort of commodity investment, which has this paradoxical impact because you actually need a lot of heavy capex into things like copper to realize the electrification and create the energy demand that we see today. So basically, we are in a structurally inflationary environment. So, I think that's something that should anchor our expectation of what happens going forward. Within that context, how should we invest, and restructure investments so that companies are resilient, and one thing I have found in my research is that you can actually basically create a strategy where you look at stocks whose returns are positively correlated with bad inflation shocks, right? So it's a mouthful, it's a tongue twister. So let me say it again, right? Basically, companies whose stock returns go up when we get a bad inflation shock, right? And how do you do that, right? And the way you do that is by so I don't know if I can share screen here. Can we see this?
I can. You did
Nice,
it.
nice. So at Bloomberg here, we have basically a time series that we have created. Oh, I don't. Okay, can you see this?
We see it. We see like the rest of the PowerPoint around it, but I don't think
Yeah.
that's okay.
Let me zoom in a little bit. Okay,
Yeah.
perfect. All right. So basically, what we are seeing here is the economic surprises, and what we basically collect all the public data, right? On the terminal, you can enter ECO. You can see all this data. Is basically every single day there is public economic data coming out. Some of it is related to inflation. Some of it is related to growth. So, for example, here for growth side, we see ADP and employment growth. How many hours people are working on average, and so on and so forth, right? And NFP job prints. On the inflation side, you see things such as your typical monthly CPI, month on month or year on year, but you also see things like average hourly earnings, right? So all of these data points, you can take the consensus expectation and the realized value and take a difference of the two. And if the difference is positive, that means it's a positive surprise, right? And if it's negative, then it's a negative surprise. You can sort of calculate these surprises. And that's how you are able to actually have a gauge, on whether or not inflation is surprising to the upside or downside. So if you look on the top here, right, the two lines, one is orange, one is blue. Orange is basically the cumulative inflation surprise, and we can see that it was positive for most of 2022 to 2023, right? So I'm here only plotting the last 2 years. So even the last 2 years, even as inflation came down, we continue to get positive inflation surprises whenever the line goes up, right? And those would be the days when we sort of got a bad inflation shock. And the blue line is just growth surprise. And by the way, the reason why we are seeing the Fed cutting rates finally is exactly because we've been in this territory. If you look at the top chart to the bottom, to the furthest right, since July or so, right, we've been in negative inflation or growth surprises. In other words, we keep surprising to the downside, right? And that's the justification for cuts. But what this also allows us to do then is to basically gauge how many stocks have sensitivity to bad inflation shocks, right? And that's exactly what I have done in this strategy that I have created, which is essentially to look at the performance of stocks that have positive surprise inflation surprise correlations. In other words,
Mm.
this is basically a productivity shock, right? You are saying if inflation is surprising to the upside without the growth surprise to the upside, that's equivalent to workers demanding a higher pay for not working more or being more productive, right? So how do you actually sort of hedge against that is to
Mm-hmm.
basically look for stocks that have positive correlation with inflation surprises.
Okay, interesting. Well, what do you see? What did you find? Are there certain pockets of the market, certain stocks that are showing this trend?
Indeed. So can you see this?
We can.
So this is well, forgive me the labeling on the legend. I think this is a chart that's created somewhat quickly, but basically, here I'm showing you a long short factor index that gives us, how this, inflation sense surprise resilient, thing would have performed, right? I take the stocks that are resilient to productivity shocks and short the stocks that are not resilient. And you see this has gone up on the long run over the last 20 years. And especially since 2022 has gone up a lot, right? And this basically tells us that we are living in a world where you basically want to be long stocks that are resilient to bad, productivity shocks, which is going to, I think, become more, frequent as we progress from here. Unless, of course, we get massive productivity boost from AI.
Mm-hmm. Okay, so what's in the index?
Yeah, so you get, I think, interestingly, you get a mixture of tech and So here I'm showing you uh, like basically this is a diversity, or this is a breakdown of the different sectors, right? And
Mm-hmm.
contrary to what people might expect, right, from a something that's sensitive to inflation, this is importantly sensitive to inflation surprises. You have a lot of tech exposure. That's the top turquoise color stuff, right? So
Yep.
technology companies are actually quite resilient to bad productivity shocks, right? And then you also get things like consumer discretionaries, you also get things like, communications, but in between, yeah, it's consumer staples, but in between you have energy companies popping in and out and healthcare. So it's a good mix of
Mm-hmm.
different types of companies. And here's the top holdings of this index on the resilient side. You can see how this has evolved over time. And have had different types of companies being featured. Apple is in here that represents tech, but then you've had, so Exxon in here, Google, and more recently I've had Home Depot, Nvidia, right, in
Mm-hmm.
2020, and the Philip Morris in 2022, and so on and so forth. The upshot is that basically this is actually to myself a surprising way to systematically identify companies that are resilient, that are productive, right? That are able to be productive in the face of poor productivity shocks.
Yeah, interesting. Outside of the data and the charts themselves that you're seeing, are
Mhm.
there any kind of thematic commonalities between thematic in a broad sense between these companies? And you mentioned tech companies using AI to be more productive. What are there any other sort of themes that come across in this group, or is it purely like this is what the data is showing you?
Well, yeah. So I think this the reason why I was showing you the sector chart earlier is exactly that, right? I think it's basically where does the economy sort of see productivity gains, and that varies over time. So that's what's really, I think, common across these companies over time, and part of the reason why you want to take in a systematic approach, because it's not necessarily obvious that you can just sort of reason it out a priori. Some people may be able to, right?
Yep.
But this is what is being captured by the data and emerges.
Okay, interesting. So you're saying we're not stagflation, obviously, but we are in stagflation-ish
Yeah.
territory. You mentioned the 70s, and that's always kind of what gets brought up in the context of stagflation.
Mhm.
What for and I know you have a PhD in economics, right?
I
So
do.
to
Yeah.
give us the history lesson, what was happening in the 70s that's maybe different than what we're seeing now, or the same, that is causing people to kick up? Because I feel like every now and then stagflation comes up. But looking at the 70s, what the situation was, and now, what are the similarities? What are the differences?
So a big difference, with the 70s from today is of course demographics, right? We're just in a generally less inflationary, general macro backdrop, right? In the 70s, you had a lot more young people, and after the war, there was, sort of in the 50s, you had these, baby boomers, and they came of age and they were productive, they could generate a lot of wealth, and they wanted to, sort of buy stuff and consume. And then if you had some kind of a supply side growth shock, like the oil embargo and
Hmm.
various things, you've created essentially this environment where inflation can shoot up. But once it shot up, I think in the 70s the Fed didn't quite manage sort of expectation well. They were quite new to the whole like fiat currency game, right? How you remember the US only abandoned the gold standard sometime in the 70s, right? 71, I think. So there
Yep.
is basically almost a sense of like, we have this new, instrument, this new system. How do we work it? We didn't really quite know it. So it created an environment where it was like created a bit of a spiral, right? Inflation and wage and prices started spiraling out, and that was kind of an oops moment. And that's exactly what the Fed is keen on avoiding repeating, right? Famously, Powell wants to avoid becoming Arthur Burns, who was the
Yeah.
Fed chair at the time. Uh,
It
so
goes back
today,
to what you were saying about the
yeah,
legacy building, because you don't want to be
absolutely,
that. How many Fed chairs can people name? You don't want to be
exactly.
that guy.
Exactly. Yeah. So, but if you look at today, though, like inflation expectations actually are well anchored. That's one thing that Powell was very emphatic at emphasizing, and the Fed has been emphasizing. Yeah, one can argue that that's actually one of the reasons why we've actually been able to accomplish what I call effectively a soft landing, where inflation came down from 9% to 2 point something percent, or low 3 point something percent, without a rise in unemployment. There are other structural reasons, but that's, I think, partly a reason. And I would encourage people to look at inflation expectations not by looking at the surveys, by the way. Like if you look at UMich surveys and
Hmm.
conference board surveys, those numbers can go crazy. I think when you ask people, they don't necessarily know, right? So they give
Yeah.
you a big number based on what they have observed recently. But if you look at market-based inflation expectations, whether it's inflation break-evens based on treasury tips or inflation swaps, we see a slightly elevated, like 2.5, 2.7%, sort of long run inflation expectation over the next 5 years or 5 years beyond, but nothing too crazy, right? So, we are in a modestly more inflation environment, but inflation expectations are very well anchored. So that's another key difference with the 70s. So between those three things, and finally, I think one last reason that I think is not mentioned nearly enough, in my opinion, is actually the fact that, for better or worse, we are in a much more wealth inequality
Hmm.
environment, right? Great wealth inequality actually, ironically, means you actually get less inflation. And give you an extreme example, right? If I print $1 trillion new money and give you to you, Katie, right? One person, right? I guarantee you there's not going to be much CPI or inflation, right? The
I mean, I
reason is
could figure
because,
out how to spend it.
but
I
the thing is that
could figure it out.
you can spend, but
I know what
how
you're
much can
saying, though.
you?
Yeah,
How? Yeah,
I'm not gonna buy everything in 17 Walmarts
you
times
you
whatever.
you'd be hard pressed. Like the other day,
I
someone was
know.
asking me, how do you create a $2,000 pizza?
Yeah. That's
How
what
do you
I
do it?
mean. Yeah, I live in New
Right.
York, and sometimes I'm like, man, people just spend money on the craziest things, but they run out of things to spend money on. But it's a great point.
Correct.
You put that money in the hands
Correct.
of a wealthy person, they're not spending the
Yeah.
same way.
And
For
wealth
sure.
inequality, what this means is that you just basically get asset inflation and not CPI inflation, and that's part of the reason why we see this big difference, right? So
Yeah.
I think that's the third reason
Oh,
that's different.
all
Yeah. Do we
right.
have Ryan?
We have Ryan coming on with the opening bell. Ryan Detrick, Chief Market Strategist at Carson Group, is hopping on in. Ryan,
Hi,
what's
Ryan.
up?
Very nice to
I'm
meet you.
here. Good morning, guys.
He's
Thanks for having me back.
here. How are you?
Pushes back. I wasn't sure I'm zoomed in. I'd be. That's a little
No,
close.
you're
There we
good.
go. That's
That's
better
a nice
though.
crop right there.
Yeah,
A
you
nice
know, I
crop.
mean, I have to get it close so you see like the side of my walls, and we don't want to see that.
No.
So, good
No
morning.
one wants to see a wall. Good morning.
You know, it's a nice wall though. Yeah, I just did a about a 45-minute presentation with our Carson advisor, so I'm all warmed up, ready to get talking about all this stuff going on. So I guess the second time I've done this with you guys, so thank you. I guess I made the cut. You brought me back, so thank you.
You definitely made the cut. You can come on whenever you like.
Thank you.
And so this presentation you just gave, is there any what were the most sort of slides? What were the big takeaways?
Yeah, so good question there. I mean, I think last week was really interesting. I'm sure you've talked about it before I joined, but we were down every day, and then Friday happened, right? But when you peel back that onion, yes, Powell came off a little bit dovish there. I think the thing that surprised me, Fed fund futures right now are like 85, 86% chance of a cut. Small caps up 3.8% on Friday. They're kind of saying, no, we're not taking the bluff here. We think there's a cut coming. We would be in the camp there's a cut coming. But again, as market participants, and I'm sure most listeners to this show, we care about what the market does, right? We can talk all day about the Fed or inflation, all that geeky stuff, but we're looking for little clues, little nuggets. We had a 90-90 day, meaning more than 90% of the stocks were up on the day on the NYSE, and more than 90% of the volume were up. The last time we've seen that was like April, off the April lows, right? Yeah. Before that, you're talking like COVID. I mean, I looked back, guys, when you have a 90-90 day, this is going back a long time using Ned Davis research. 1 year later, S&P's higher 11 out of 12 times, up like 23% on average. So it's just one sample size, yes, with extremely strong performance going out. 1, 3, 6 months later. So I think it's really important that strength we saw on Friday is likely another kickoff to what we already know. At least I think we know. We're in a bull market. This is a global bull market. It's strong. Now, one more little thing for you, then we can dive in a little more if you want.
Yeah.
About the Fed. I was on CNBC the other day, and I don't know how many market strategists have ever done this on Friday afternoon, but I actually quoted Tom Petty on CNBC. I said, the wait is the hardest part. Now, what I'm getting at, we are probably going to have a cut in September. I think it's September 17th, but don't quote me. Close enough for government work, whatever that Wednesday is. And it'll be 9 months from the last cut. So I got to thinking, okay, so we cut, we waited a while, we cut again. What could that tell us? What could we find from that? So I found lots of times the Fed cut and waited like 2 or 3 years. So, that's not this scenario. So I found all the times that waited between 5 and 12 months from one cut to the next cut. Again, the wait's the hardest part. Similar to the stats I just threw out, this time S&P's higher a year later, 12 out of 13 times with some really strong performance across the board. I think 2001 was the one time markets were down, 9/11, a recession, not great stuff happened. But the majority of the other times you have a decent weight in the middle between cuts, you tend to do well. And listen, every cycle's different. Everything's always different. I get all that stuff. But the reality, I think the Fed came off dovish. We have a slight concern with inflation. Services has been a little bit on the hot side. We get core PCE this coming Friday, which along with Nvidia are the two big events, I guess. Is kind of a quiet week, to be honest, which is nice. Last week was crazy. So maybe, we'll get a clue there, but I think it makes sense that the Fed should be cutting. One final comment, put a bow on this. Okay, maybe we get 1 cut, 2 cuts rest this year. We'll see. The market knows there's somebody in charge of the Fed new coming in May. We are looking at 1.25, so let's call it 5 cuts over the next 12 months, because the market is sniffing out whoever the next person is probably going to be dovish. They got a new couple governors coming on, probably going to be dovish. The reality is there are cuts, lower rates probably coming, and that's probably why we just had one of the largest broad-based rallies in the history of the stock market on Friday, because it sniffed a lot of that stuff out. So that's my opening salvos. I'll take a drink, and we'll go from there.
Yeah. I mean, well, I want to ask what Petty song would play Powell out. I think maybe like Last Dance with Mary Jane or something. They got to think about the whole catalog that you could use. I love it. I love the Tom Petty references.
He's a deadhead, right? I'm pretty sure Powell that didn't. I think they saw him at some basketball games back in the day wearing his dead stuff. So maybe a song.
He's been seen going to the Grateful Dead concert, right?
Yes.
Yeah.
And he was seen at the airport having a sad airport beer by himself, which honestly was the most relatable. Like, who hasn't had a sad airport beer at like a Chili's too?
Yeah.
Yeah, they showed him coming into the place, and I get it. You can take a picture, and he looked just miserable getting to Jackson Hole, and he's all beat up leaving Jackson Hole. But I will say this about Powell, so we can slice and dice it. I was glad he didn't go the route that some people were maybe hyping up more than it was going to happen. But was he going to take his last chance with the mic in front of him at Jackson Hole to really berate Washington, berate Trump? The Fed should be separate from Washington. We all agree with that stuff and everything going on with President Trump and him. Listen, we all seen the news. I was really proud of him for taking the high road. He just did his job and said, listen, the labor market is showing some cracks. Yeah, we're still worried about inflation. Services inflation shouldn't be going up. We understand why goods inflation is going up because tariffs are out there. Now we're starting to see services go up a little bit. But the reality is the labor market's weakening a little bit quicker here. And that's why he said we probably going to start cutting. And he took the high road. So that was I appreciated that, I guess. Well, and the market did too. Yeah. There he is.
Yeah, there he is. He's also got to save that for his book, though, you know? Well, yeah, that's coming.
Yeah,
I'd love. I mean, long term.
You can get him on this show. I've got a podcast, Facts versus Feelings. Maybe we can get him on that. I mean, he'll probably go work for PIMCO like all of them do. And we can just ask PIMCO real politely. We've been trying. She worked. Yellen works over at Janet Yellen. She works at PIMCO. We tried a couple times to get her, but she's hard to get. I think.
I didn't know she was at PIMCO. I mean, she's probably.
I don't know if she works for him, but
I think she advised them.
They pay her to say she's there.
Hey, you get that 6 fig show up at an event thing, do that a few times a year.
Exactly.
Ryan, can I ask you a question regarding, so one cautionary view people have had, right, about Fed cutting here is what happened last September, right? When the Fed cut last September, a mega cut, 50 bips, followed by 2 more cuts. What happened was that what was thought it was a growth, this acceleration was actually a growth scare. Inflation came back up, and 10-year yield actually shot up as well.
Right.
What do you think about the risks of that happening here?
Yeah, Steve, that's a great point because again, we were in the camp this time a year ago. The Fed should have probably cut their. I think it was August, whenever the first meeting before the first. Then they did a 50 basis point cut. And everybody said, "Oh my goodness, 50 basis point cuts." They did it in 2000, 2008, and a 100-year pandemic. So bad things are happening. We said, no, that probably not the case this time. Unfortunately, it wasn't. But you're exactly right because everybody said, "Oh, the Fed's cutting, so that means my mortgage is going to get cheaper to go refinance." And the exact opposite thing happened because it was more of a kind of a hawkish cuts, I guess, is what maybe we could call it. But the reality again is I'm not so sure that's going to take place this time. I think the Fed's going to be a little more measured this time because they did 100 basis points, all boom, boom, boom. And the market, I guess you could say, sniffed out the fact that they were probably going to go on pause. Right now, I think it's more going to be like 25, 25, and maybe a couple more 25. So it's a great point. Now, I will just say structurally, I mean, you've got Japan, 10-year yields, like breaking out to like some of the highest levels they've ever been at. So there's some global yields moving higher. With the U.S., we'll have to see. But I mean, from a portfolio point of view, we are still overweight stocks relative to bonds, and we've been that way for 3 years. It wasn't always popular having that call, but that's where we are. So that's some interesting. That's some interesting points of view. We're a real smart guy named Son of Varghese. He lives in his stuff, breathes it. He shares a lot of cool stuff on X and different places, and a lot of public stuff we talk about. So it's exciting what he'll dig in, but for now we're not so sure. One other thing that's caught in my mind, if I can say this, 10 years ago yesterday was the first 1,000 point Dow drop ever. Now I get it. We've had worse days, but I mean, 10 years ago, 1,000 points is a pretty big deal. That was on this surprise Chinese yuan devaluation. It's almost like a footnote in history. It's almost like, oh yeah, I do remember that. If you were there, that was a really, really scary day because the yuan devaluation is going to kill everybody and everything's going to fall apart and the market's crashing globally. And now here we are up like 260% since then the last 10 years. So I think it's important, just for, of course, I'm a strategist and RIA. We manage billions of dollars. We do kind of look probably a little more long-term than maybe some of the other guests do. But the reality is we're going to have bad days. I think it's important to know that every year is going to have scary headlines. This year wasn't any different with the 20% drop and a 10.5% drop in 2 days on Liberation Day. Maybe we're going to get something else again here coming up sooner than later. But we're going to get through it. I think it's the most important thing. I just love to remember. And I remember 10 years ago when that happened, it was wild.
Yeah. You got to zoom out. Did you have your phone ringing a lot that day, Ryan?
So the funny thing about that day, at the time I was unemployed and I had major back issues. So I remember I could barely walk and I was going to my back doctor. I remember being at my back doctor in the office, I'm waiting to see him and the TV's there and the market's just getting crushed. I'm unemployed. My back, I can barely walk. I was like, I hope this is about as bad as it gets because that was not. That wasn't very.
What else can you give me?
It wasn't very good. Now, fortunately, 10 years later, market's up a ton. My back's good, and I'm having a lot of fun. And shout out to Howard. I don't know if Howard's watching right now, but Howard Lindsay got me out to Stocktoberfest probably back in 2014 on somebody's dime. I don't know who. He's like, hey, you should come out here. Flew me out there, met some people, directly connected me with the job I eventually was hired from in that little with LPL Financial, and now I'm obviously Carson Group. So anyway, just a fun community. You never know who you meet and who helps you along the way. So shout out to Howard for getting me out there.
Good old Howard.
Directly where I am right now.
What a guy. Yeah. Well, I'm glad you brought up Stocktoberfest because that's coming in hot. October 20th to 22nd in beautiful Coronado, California. I will be there. Ryan, I assume you're going to be there. Or you might be there. We might see you.
I'm a serious maybe. It's my son's birthday, unfortunately.
I'll bring your son.
Well, he's got school. He's playing sports. He's in high school now. If you miss a day, they they go nuts. But
what sports does he play?
Sure. But let's see, football. So we had to get up at 5 a.m. Eastern time to get him to football practice, 5:55 before school.
I was gonna say, is it 2-a-days? But now he's like,
no, it's just one. And I tell you, like when you get up that early, like I don't know what time. What time is this? 9:41 Eastern time. I'm starving. It's lunchtime. Like I am starving right now. But anyway, no, I will say who's never been to Stocktoberfest, been to a few of them, especially they're so special out there at the Dell on that back porch, meeting everybody, hanging out with you. If you want to go, you're wondering should I go? I'm a perfect example of someone that went there, met a bunch of people, and it directly helped my career. So you're not doing it just for that, but the networking and hanging out and stuff. So definitely, if you can make it, I would say you should go. Check out.
Wow, you guys have really sold me on it. I've never heard of it before, and now I want to go.
Well, you have to come, Steve. Obviously, 2 thumbs up from Ryan. Bring your own lederhosen. It's going to be a party. On a lighter note, I'm curious. While we're a little off topic.
Yeah, it happens when I go on these things. I'm sorry. You never know where I'm going to take it.
That was a great place to be. And I want to get back to the macro stuff, but do you guys have any hot takes on the Cracker Barrel logo?
I do. I don't like it. I actually went to so I travel a lot. I like Cracker Barrel. I mean, like you know what you're going to get. It's consistent. You know what you're going to get.
I'm a shareholder.
There you go. Well, I don't know. I guess I'm old fashioned. I don't like a lot of change. I get it. I understand the problems and why they have to do some of these things. But you just look at all these companies, like they showed like what an old McDonald's looks like compared to now. Taco Bell to now. Well, Taco Bell to now. It's like, why are you taking away the fun? I mean, if they take away the peg game, we got a real problem then. I mean, the peg game has to stay. There it is. Just boring.
I think one thing I would like to say on this is I think on a higher level, I do think there's an underappreciation for basically the scarcity of legacy, right? I think Cracker Barrel represents, I think I've never been. I only just bought the stock because I thought the economy was gonna, take a dump last year, and I thought maybe this is a good recession bet. But generally, I thought, this is part of a legacy, right? And you want to sort of keep that as much as possible and not abandon it,
Well, that's Uncle Herschel on the left, and he's got the Uncle Herschel breakfast. I've had that many times on the road, and I love they've got an awesome dessert, the Coca-Cola chocolate cake. I don't know, but it is, like someone again goes to Cracker Barrel often on the road by myself. I just know what I'm going to get. I love it. I don't know. Call me old fashioned. I don't like change.
I read they're getting rid of the little gift shop, which is like the best part. There's Steve. So when you go in, there's a gift shop.
Okay.
To your point,
save everybody money. Your kids always buy a bunch of junk in there when you go in there, but nonetheless, that is absolutely. It's nice that you go to Cracker Barrel. You need to get something. I need this. I need that. Oh, I'll just get it when I'm at the Cracker Barrel store because they'll have.
So are they only just on the highway or what?
No, they're in like rural areas, suburban areas, but like when there is one on the highway, to your point, you go because it's like McDonald's. It's the same thing. You go to Cracker Barrel. There's like old timey toys. You can get rock candy. There's Coca-Cola inspired desserts. Like I don't get
the hash brown casserole. I mean, let's not forget the hash brown casserole.
I don't get it. I wrote about it in my newsletter over the weekend because it's interesting that now that like everyday people are investing, this stuff really matters. Like American Eagle, went up on Sydney Sweeney, and then
so American Eagle, they have earnings this week. I can't wait to hear what they have to say. But 91% of all the stocks on the NYSE were higher on Friday. I mentioned that when I started. Cracker Barrel was down, right? I mean, so that tells you, they were down obviously a lot the day before when all the news broke. So we'll see if they'll pop eventually. But it's I don't know. I'm not a marketing person, but I'm not crazy about it. I'll just leave it there.
I mean, no, the thing is, everyone's kind of a marketing person now. We all kind of get the game, and so it's interesting when these things happen. Speaking of earnings, so obviously we have American Eagle. We'll see what's going on there. I know they had some. Their stock kind of got memed a little bit, but foot traffic was down, so we'll see how like the early readout is from them. But Nvidia on I believe Wednesday.
Yeah, Wednesday night.
Wednesday. Yep. People thinking it's going to be good. Not surprising. Steve, Ryan, any thoughts on this? And kind of do you guys think this continues to be like the stock that sets the tone for AI, or is there any sort of democratization happening where it matters less?
Yeah, feel free, Steve.
I mean, I just remember a couple of years ago when I was talking to my friend Citrini, and I was asking him why whether I should invest in Nvidia, and why the stock shouldn't be $1 trillion stock. This was at the time was 500 billion, right? And now today the market cap is 4 trillion. So I mean, I think Nvidia's, I think he keeps getting underestimated because people think it is a primarily hardware cyclical business that just happens to have found this moment. When reality is that it has that massive moat when it comes to software. People built that into their workflow, right? And it's difficult, I think, to switch once you sort of have already integrated, and I think Shay, who's not here today, he has made a very good point about power efficiency. As expensive as NVIDIA's chipset are, they are very power efficient because they've been at this game for such a long time. And we have such a big power shortage in this country.
Yep.
And all the hyperscalers who are trying to build out, they're just looking for any energy they can find. So if you can save on the energy, even if the margins are high, even if the chipsets each generation gets more expensive with the depreciation, it might still work out to be very profitable for them to stick with NVIDIA. That being said, right now, I think the problem with NVIDIA remains on supply constraints, right? It's just that whatever they can produce, it's not meeting remotely the amount of demand there is. And that's why you get this sort of overfill being met by AMD and other chip makers that are not as good, especially on the software side. I think that's part of the reason why we see the staying power. Eventually, I would imagine we'll get to a point where you won't need as many chips for training the foundational models, and inference perhaps could be done with other types of chips. For now, I think we are still very much in the earlier phase and the demand seems to be pretty much endless for NVIDIA chipsets. So that's kind of my high level take. And I remember I saw there was a last week that apparently I missed it. There was a bit of bearish news coming from this MIT study where they surveyed a bunch of enterprises on their adoption, and there was some number about 95% not finding usefulness or somehow able to document productivity gains or P&L. But the thing is that I actually saw that as rather bullish, in that it seemed to me all I read was all the enterprises are very eagerly adopting and trying to figure out how to use this new technology. Everyone recognized this was a game-changing event, that nobody wanted to be left behind. The fact that it takes them a while to figure out how to use the new piece of tech to make it productive in their workflow seems entirely natural to me, that I didn't see there's a bearishness in that. But Ryan,
that's a great point by Steve there, because again, I know the All In podcast talked a little bit about that also, the MIT study that again 90% of companies is, or what is it, 95%?
95, yeah.
95, I thought it was 90, but either way, a lot, but who knows?
Yeah.
Another fun little Stocktoberfest story. It probably was Stocktoberfest 2017 or 18. I forget exactly, but it was out west in Coronado. And I remember in front of the room, they said, what's going to be the first $1 trillion company? At the time, it sounded crazy. I mean, I think like companies had to double or triple since then. I mean, I think most people picked Apple. Howard asked, Apple, most hands probably were Apple, but that's how wild it is, how far we've come. I've used a quote. By now, people realize I have a face for radio. Every time with the media, they're like, I use a quote every time. Death, taxes, and Nvidia beats on earnings. I've used it for 3 years now. If they beat, I'll probably use it again. You'll probably see me quoted somewhere. So Steve really went in the nitty gritty of it. I'm in the camp though still that there's just so much potential. We get it. They got ahead of themselves. The mag, like last week's, a perfect example is, look what lagged. Mag 7 lagged. Maybe that MIT story, maybe it's just time. But what I love about it is the baton being passed around. Industrials are up 17% on the year. S&P 500 is up 11. You look at the R squared correlation coefficient. Industrials in the market usually trade a lot alike. I mean, that's a pretty broad base. You think about what's the broadest sector out there, in my opinion, it is industrials. I mean, Uber's in there, all this different stuff's in there. So to see industrial strong, financials hitting all-time highs, I mean, tech is still there, maybe time for a little break, that's okay. The baton being passed around is, as a lot of us say, the lifeblood of a bull market is rotation. We're seeing rotation, and that's fine, but I'd still, we have a slight overweight to technology, a slight overweight to large caps. So by nature, I guess you could say I'm kind of rooting for Nvidia here. But we don't, hope's not a strategy when you manage money, but at the same time, I think there's still a lot of potential, bigger picture for the Mag 7 in general and Nvidia.
Yeah. I think Steve brought up also the MIT study. I think that might be a function of sort of an education gap, because even what I see in the companies I work with is there is a lot of enthusiasm for adopting this technology, but like very few people know how to do it correctly. And you could, I mean, I know these are enterprises and there's like a CTO, but like if the survey was broader than that and it was outside of people who are very technically adept, that makes sense to me. People trying things, they're like, I don't know. And also it's hard to quantify the value of that. You can say time savings, but it's not just shortening the task time, it's also adding depth. And how do you measure the value of that depth?
Exactly. Well, especially when you sit within a big organization, to pinpoint P&L and productivity gains is very difficult. I mean, forget about AI, just anything we do, right? But one thing I do like is the concept of reveal preferences, economics. People, like when I walk around the office, every single person has got a tab of ChatGPT open, right? Every person, right? They wouldn't be doing that unless they are finding something useful out of that exercise, right? That they're able to help them complete tasks. So, but just to pivot a little bit, Ryan, I saw in the show notes earlier that you were mentioning a point that I very much agree with, because I was predicting some kind of a summer melt-up catalyzed by the defensive Fed, right? This was like maybe back in like June or something. And once we started getting some of these trade deals, I think you said something to the effect of like anticipation of rate cuts was actually bullish. So I wonder what you think about this summer, I guess some kind of a melt up or grind up with the experience and how you expect it to go forward.
Yeah, we were in the camp that market was going to have a surprise summer rally. I mean, I love, again, looking at what's going on in the world, right? On April 9th, 98.9% of all the volume on the NYSE was higher. That was that big update, 9% update. But most volume was higher. And we looked at, I saw like, that's like the low. That's low. We said we wanted one more strong day. April 22nd, we saw another really strong day with like 98% of all the volume higher on the NYSE. We're on record the third week of April saying that's it. That's the low. That wasn't very popular. Everybody told us we're going to roll over. Everybody told us tariffs are going to kill everything and blah, blah, blah. But the message of the market was saying we're going to see a summer rally. Selling may go away. We all know about it. The media hypes it up, but it hasn't been accurate at all. We've seen some strong summer rallies lately. I will say August historically is a little bit of a weak month, especially in a post-election year, especially with the second-term president. Now, I get it. President Trump, is he second term? Is he second term with asterisks? I don't know. But like the last 5 times we've had a second-term president in August, stock market has been down. So we're probably going to have an up August here. I love looking at seasonality. I don't know if you guys have Mr. Hirsch on, but he obviously he does a lot of good work with seasonality. I mean, September in a post-election year can be a little dicey after all we've had. Maybe we're due for a little bit of one. I mean, we haven't had a 5% pullback, I think, since May. I think, and we usually have like 4 or 5 of those a year. So I think we're maybe due for a little bit of break. But all the stuff I just listed when we started, there's so much buying pressure, so much strength in this global bull market. I don't think it'd be more than a 4 to 6% pullback. And if that were to happen, I'd still use this opportunity because I think we're still alive and well. Maybe the next 6 to 8 weeks, maybe some dicey moment or two would be perfectly fine. We manage a lot of money. We actually took a little bit of risk off a couple weeks ago. I know the market's gone up since then. I get it. But, we're still thinking maybe there's going to be a little better time to add a little bit more in. But we're still over at equities. We like the cyclicals. We like the large cap areas. And we have an even weight to developed international. I know, okay, well, everyone does now. But we actually added that back in March, right, when we saw more fiscal policy and different things taking place in Germany that were kind of this time is different. 4 most dangerous word, Sir John Templeton. But we saw more opportunity, and that clearly is played out with a global bull market. I follow 39 markets. There's not one negative on the year, right? There was, U.S. was down, India was down, Taiwan, nobody's down. I mean, that is a nice backdrop for a global diversified portfolio. We think there's still a lot of opportunities for investors going forward. Maybe once we get out of this potentially weak seasonal period, still pretty optimistic.
Yeah. And we got it's coming in hot, the next Fed meeting. And I know people are, the odds, I guess, 85, 91% rate cut. But I know, Ryan, you were saying anything could happen. So what do you think happens if we get to that point and there's no rate cut? What's the impact there? Is it?
Great question. I don't think market will like that. Market will throw a fit. I mean, the reality is we have a jobs number coming out. I think, next Friday, whenever that is. I think it's the 5th. Then we obviously have a CPI and a PPI coming out. Then we have a big jobs revision on September 9th as well. Now, most people expect to see a lot of those jobs just go away. And that might actually help our argument for a rate cut, which is funny because obviously President Trump got mad and fired people when the jobs numbers look bad. But if he wants rate cuts, maybe you want weak jobs. I mean, who knows? But the reality is, I think the market will throw a pretty big fit if we don't get the rate cut that Powell, the way, who put it this way? I forget. Someone put it this way. I forget who. Sorry. Skanda put it this way. Skanda Amaroth. He said the Fed opened the door, but that doesn't mean we're going to walk through it, right? The door's wide open, but they need to see some, hopefully tame-ish inflation. Maybe this Friday we'll get some of that. A weak-ish labor market. That's good. Although it's funny. I mean, I know it's the old be careful what you wish for, because normally if the Fed's cutting aggressively, it's because the economy's slowing down. You go into a recession, that's not good, right? Well, last year the economy didn't slow down. Now Steve pointed out yields went higher, but the market did. The stocks did just fine. But the reality, be careful what you wish for. But I think it makes sense. I mean, we were on record in January, February, March. The Fed should have been cutting then because inflation wasn't a worry. In our opinion, the door was open for cuts. And then the tariffs happened. They had to be on pause. And now here we are. With I think the Fed a little behind the 8 ball because it should have been cutting earlier this year. Maybe the labor market wouldn't be as weak as it was. But hey, water over the bridge, or whatever that expression is, water under the bridge, whatever that expression is. That's where we are.
All right, Steve, any final thoughts on what Ryan just said? What's the scenario in your mind if we get a couple weeks from now and no movement?
I actually have been of the mind that the longer the Fed doesn't cut, the better it is for assets, for stocks. It is not the stock market that needs the rate cuts, in my opinion. It's the real economy that may benefit from marginal rate cuts because sort of the pressure the labor market has been under. Not to mention the housing market. The stock market doesn't really need a rate cut, and the expectation of rate cuts coming with real rates being high, keeping real economy, sort of on some kind of pressure on the real economy, and therefore inflation is probably on the balance the ideal scenario for stocks. So, it's exactly what Ryan has just mentioned. Be careful what you wish for. We might have a scenario where the expectation, the rumor of a rate cut may actually be better than the realization thereof. So we'll see.
Well,
clear as mud.
Yeah, I'm gonna use that. That's a good one.
Good.
By the way, I just want to mention one quick thing. So the last time I think I showed this chart as well is that during the .com, the Fed basically didn't cut, right, and he paused and then he hiked, and when it started hiking, the Nasdaq went crazy, and that was the .com analogy. I don't know how applicable it is to today and what Ryan thinks about the .com analogy because it's tiring, but you never know, right?
No.
Interesting. Well, guys, thank you so much for hopping on. Ryan, I got to shout you out. You are so good at crediting where you get inspiration for ideas in a way that very few people do. So big ups to you.
Well, I live by this. If you take it from one person, it's called stealing, but you take it from everyone, it's called research. So we all kind of get ideas and use it from each other. And a lot of people use my stuff and quote me and cite me. So, well, thank you for that.
And if you use Ryan's stuff, credit him. Karma's real. And Steve, thanks as always. I know you spent some time over the weekend pulling together some of those charts for us. We appreciate you. We hope you guys have a solid week, a successful week, but also a restful week ahead of Labor Day. And you guys will have to come back on soon. And we'll be back tomorrow, 9 a.m. Eastern with the Daily Rip Live to talk even more about these topics and more. And we'll see you then.
Thank you.
Thanks.